Big bank earnings kicked off with a bang this morning. Strong showing from JPMorgan, from Wells Fargo, and from Citigroup. JPMorgan seeing profits surge 35% from the same quarter a year ago. Wells Fargo posting a beat after taking advantage of higher interest rates to counteract a slowdown that they're seeing in lending. For more on these results, we want to bring in Nathan Stoval, S&P Global Market Intelligence Director of Financial Institutions Research, and we have Dave Ellison, Hennessy Funds Portfolio Manager, joining us now. Great to see both of you. Nathan, let me start with you, and let's start with what we're hearing from JPMorgan. An extremely strong report here from the company. Profit up 35% compared to a year ago. What's your takeaway? And I ask that with my takeaway being, once again, JPMorgan really showing its dominance here at this point. Nathan, I think you might be muted. All right, Nathan, we're going to put you on hold here. We're going to go to, we want to bring in Dave. And Dave, I'm going to ask the same question to you, frankly. When you take a look at JPMorgan's results here, clearly coming in better than expected at both the top and bottom line, what was your big takeaway from the numbers that we're getting this morning?
Well, the takeaway is that the economy remains strong as we see all the numbers, and that's reflected in their loan demand and to some degree their credit performance. Let's remember that a lot of the analysts really have taken down their numbers, and so beating the numbers is relatively easy. And so I think that's, when they say they beat the estimates, I mean, Wall Street's been pretty bearish about margins and pretty bearish about credit. Certainly, they've had some bank failures this year to worry about. So I think we're in a situation where the worst of the margin pressure is over. Now we're sort of waiting for credit to kick in as the Fed, starts to, try to slow the economy. So, the disappointing thing is that JPMorgan was the best last quarter, and they'll probably be the best in terms of performance this quarter. So we're getting the best of bank earnings today, and the rest is going to be not quite as exciting. So, but again, it's a macro play, and that's the difficulty here, is that it's about rates, it's about credit, it's about liquidity, and all of that is controlled not by JPMorgan, but by the central bankers and to some degree the federal government.
Nathan, just as we stay on kind of this theme of what JPMorgan had to say, CEO Jamie Dimon not exactly saying, hey, this is going to be a glaring recession that we're heading towards, but is saying that currently U.S. consumers remaining healthy, but spending down some of that excess cash. Businesses, seems like the environment is getting tighter for them as well here. What do you extrapolate from those comments, and how do you kind of pair that up against some of what we've heard from economists in their own predictions for a hard versus a soft landing that could spell out recession?
Sure. And the banks have effectively been over-earning on credit for some time, and I think Jamie is trying to throw out some caution, and we've seen that from other executives as well. They know that credit costs are going to go up, but the consumer has remained more resilient than I think most people have expected. The labor market's more than most people have expected. The consumer's been able to digest higher rates better than most people have expected. So I'm not surprised that we're seeing that caution as they're trying to prepare the street. But we've also seen net interest income guidance raised by pretty much all the banks, including JPMorgan. So I mean, it's a pretty strong beat from the banks here, but I think they're trying to prepare the street that you could see tougher times ahead.
Dave, let's talk about some of the proposed capital requirements that we're getting. That was one of the things that we heard a number of the bank CEOs weigh in on, most notably Jamie Dimon. He's never short of words, or isn't shy, I guess I should say, about his opinions in terms of what the impact could potentially be of certain scenarios. He was raising some questions just about the regulatory changes and the impact that that's going to have on some of the larger banks. More broadly speaking, though, in this sector, how big of a headwind do you see this potentially being?
Well, I've never, capital doesn't solve really anything in terms of making the banks better or worse. But I think it's a headwind from a multiple point of view, and a valuation perspective in terms of where they trade on book and earnings. And this industry is much about sort of earning money today as it is consolidating into the future. And so the value add of owning this space, which I've been involved in since the early 80s, has been the M&A activity. And by adding more capital or requiring more capital, you generally lower the valuations, and it makes it harder for M&A to be a value addition to the portfolio management style that you have to have in this space. So I think it doesn't necessarily hurt Jamie Dimon as an individual, but it hurts the ability of somebody like myself who's in the space to actually try to make money in it, because the M&A is a big part of why you own financials. And if you take that away through regulatory structure, it's not good for the investors.
Nathan, as we think about the banks right now and their international exposure, we heard Jamie Dimon acknowledge the geopolitical risk, the conflict as well. And it kind of takes you back to the first quarter of 2022, where this kind of instituted a wave of down guidance, or at least maybe some compressed guidance because of that concern or that risk. Do you think that this kicks off for this earnings season now some of the perhaps headwind that many executives see, and how that could impact their business as well?
I think we don't really know yet. I mean, I follow the logic of going back there, and it does rhyme with that a little bit of we're waiting to see what the impact could be. Does this make inflation sort of come back up and rear its ugly head? Does that mean higher for longer is not only higher for longer, but the Fed has to move more aggressively to temper inflation? But I certainly hope not. Thus far, it looks like we're seeing good strength here in the U.S., and I hope that we can stay insulated and that calmer heads can prevail in the rest of the world, and that things will not be as tumultuous as we've seen in the last few weeks. But I'm pretty hopeful that they might not have to act too aggressively, and that we might not be in a place that's too bad here. But it's certainly worth watching, and I think that's one of the reasons why you're seeing caution from executives here. David's point about M&A and new capital rules, that it's well taken, and it's definitely hanging a cloud over the space right now. One thing I would add to that, though, that we're hearing more from is the smaller banks actually getting closer to maybe a point of capitulation and seeing a restart of M&A activity, and maybe a little bit more consolidation from the smaller guys who don't want to bump up into this place. But David's point is well taken. That is something that is hanging over this group for sure.
Davis, are you nodding your head there? In terms of that consolidation, how quickly do you anticipate that is going to happen? And I guess to what extent are you expecting to see activity within the space?
Well, I think, as an investor in the stocks and not an owner of salaries and bonuses of the executives, the way you make money in this space is going from ugly to okay to good to great. And conditions now are good. They were great, but rates have gone up and made them more difficult. But the way you're going to make money, the way you're going to drive M&A is to have difficulty in the space. And you saw that with, for example, Silicon Valley, right? Silicon Valley, First Republic, SBNY, the companies that bought those companies have had significant earnings accretion, and the stocks have gone up. And so we need more of that. As an investor in the equity, I need more problems. I need credit problems. I need rates to go higher. I need the yield curve to stay inverted. I need the weaker companies to get weaker so that they can get merged into the better companies, and I can buy the accretive results of that. So I tend to be a little bit on the outside here thinking, okay, everybody says, well, I'm a boober and I want the things to go to hell so they'll get better. But that's the way you're going to make money in this space. You're not going to make money muddling through like you are now. Things are good, they're not great, maybe they get better, maybe they get worse. You're not going to make any money in this space under the current earnings situation, because they're good enough for the stocks to be where they are, but not bad enough for them to go down. And there just isn't a lot of new innovation. There's no new products. There's nothing wrong. So it's a boring space to be. And if you go back to the Silicon Valley back in March and April, it was a very exciting time because you could actually make money in the stocks that if you bought them correctly.
We're showing our viewers just a look at the bank heat map right now with some of the extended and pre-market moves here. Nathan Stoval, S&P Global Market Intelligence Director of Financial Institutions Research, and Dave Ellison, Hennessy Funds Portfolio Manager. Thank you both so much for taking the time here this morning. Appreciate it.